Before you buy your next stock, let's ask the most important question. Do you actually know anything about the company? If your answer is, they make cool stuff, don't worry, you're not alone. What's up, effortless investors, and welcome back to the channel. Today, I'll outline a simple step-by-step process to research any company before you invest, using the same process other investors use, just with as little jargon as possible. Now, I'm not a financial advisor, just a regular 9-to-5 guy building a realistic investing portfolio, one effortless contribution at a time. If you enjoy this kind of content, don't forget to hit the like button and subscribe for more beginner investor content and portfolio breakdowns. With that said, let's dive straight in. It all starts with one question. Do you actually know the company? If the answer to that question is no, or if it's even a hesitant yes, don't touch that buy button yet. Let's start with the basics first. Start by figuring out what the company actually does. Not the buzzwords like AI, quantum, or cloud, but the real products or services it sells. Take Coca-Cola, for example. It's not just a festive drink enjoyed by polar bears for 6 weeks a year. It's a global beverage powerhouse. Coca-Cola owns over 200 brands, from Fanta and Sprite to Costa Coffee and Smartwater. It doesn't just sell the syrup. It licenses, markets, and distributes drinks in nearly every country on Earth. When you understand that, you realize it's not simply about cola. It's about controlling shelf space, distribution networks, and brand loyalty worldwide. Knowing this helps you see how the company makes money and whether it's something people will still want and buy 10 years from now. Once you have an understanding of what they do, next ask yourself what makes this company special, or what investors call a competitive advantage, the thing that helps a company stay in line or ahead of the pack. Take Apple, for instance. It's not just out here flogging iPhones. It's creating an entire ecosystem that keeps customers locked in for life. You buy the phone, then the AirPods, the Apple Watch, the additional cloud storage, and before you know it, you're 5 products deep and emotionally attached to the brand. And that's brand power. It's the reason Apple can charge premium prices while competitors fight to undercut each other. Their competitive edge isn't just technology, it's loyalty, design, and that feeling that if you're not using Apple, you're missing out on something. On the other hand, a company's edge might come from being ultra efficient. Take Aldi, for example. It's built around simplicity, limited product selection, smaller stores, and lightning fast checkouts. They don't waste money on fancy displays or excessive marketing. Every decision is about keeping prices low while maintaining quality. That's their advantage, a lean business model that's incredibly hard for competitors to copy. While other supermarkets fight for your attention with loyalty cards and endless aisles, Aldi quietly wins by focusing on one thing, giving shoppers the best deal possible, every single time. So, once we understand what a company does and what makes it special, it's time to zoom out and look at the bigger picture and start with the industry trend. Is the world moving toward or away from what this company sells or does? A prime example for this is Blockbuster. Once the undisputed king of movie rentals. Everyone loved it, until the world moved online and Netflix made streaming the new normal. Blockbuster didn't adapt, and the market left it behind. Now compare that outcome to a company like Nvidia. They started out making graphics cards for gaming, but spotted a much bigger wave, artificial intelligence. Their chips now power AI models, data centers, and even self-driving technology. Nvidia didn't just follow a trend, they created one. So when you're researching a company, ask yourself, is this business surfing the wave of the future, or standing on the shore watching it pass by? And finally, you need to ask who's steering the ship. Even the best product can't save bad leadership. And the opposite is just as true. Great management can completely turn around a company. Take Microsoft. In the early 2010s, they were beginning to be seen as slow and outdated, missing the mobile wave and stuck in the past. Then came Satya Nadella. He shifted Microsoft's focus toward cloud computing and recurring subscription models, like Microsoft 365 and Azure. Fast forward a decade, and that decision turned Microsoft into one of the world's most valuable companies again. That's what great leadership looks like. Not just maintaining the business, but spotting opportunities before everyone else. When you're researching a company, take time to look at the people in charge. What's their track record? Have they led other successful turnarounds? Or are they brand new to the industry? Because at the end of the day, you're not just investing in a business, you're investing in the people running it. It's one of the primary reasons why past performance is not an assurance of future gains. So let's say we've answered all those questions, and we're happy that we know who, what, and why the company is. From here we move on to the numbers, but don't panic. This part isn't as scary as it sounds. We need to look through a company's financial statements to get a sense of how they are performing. Let's start with the income statement, which is basically a company's report card. It shows how much money came in, also known as the revenue, how much money went out, which are their expenses, and what's left over, affectionately known as the profit. The first thing you're looking for is steady growth. Ideally, you want to see a company's sales and profits rising over time, not bouncing around like a yo-yo, unless you can attribute that to unforeseen circumstances. Take Apple again, for example. Year after year, they've managed to increase both revenue and profits. That means they're not just selling more gadgets. They're running the business efficiently and keeping costs under control. Their gross margin, which is the money left after making a product, hovers around 40%, which is incredible for a hardware company. If the income statement looks like a smooth upward curve rather than a roller coaster, that's usually a good sign. Next up is the balance sheet. This is a snapshot of everything the company owns and owes at a given moment. A bit like checking your own bank account and bills at the end of the month. The key things to look at are their assets, liabilities, and debt levels. A strong company has plenty of cash and manageable debt. Think of a company like Alphabet, which is Google's parent company. They sit on over $100 billion in cash and short-term investments. That's financial muscle. It means they can fund new projects, buy back shares, or survive rough markets without breaking a sweat. On the other hand, if a company is drowning in debt just to keep the lights on, that can be a warning sign. Remember, in business and in life, being rich on paper doesn't help if the bills keep piling up. Eventually, they're going to get you. And finally, we have the cash flow statement. This is where we see how much actual cash moves in and out of the business. Because a company can report profits on paper while secretly burning through cash in reality. The golden number here is free cash flow. That's what's left after paying for everything the company needs to operate and grow. Companies like Visa and Johnson & Johnson excel at this. They consistently generate more free cash flow than they spend, year after year. That's what allows them to pay dividends, buy back shares, and reinvest for growth, all without needing to borrow money. In short, profit is an opinion, but cash flow is fact. Once you understand these three big financial statements, you can start to look at a few key ratios to make the picture even clearer. Don't worry though, you won't need to dust off your GCSE maths for this part. First, we have return on equity. It tells you how efficiently a company uses shareholders' money to make profit. If you invested £1, how much profit does the company generate from it? A strong business like Unilever often has an ROE above 15%, showing they know how to turn capital into cash. Next up, we have net profit margin. It's simply how much profit a company keeps after paying all expenses. For example, Tesco runs on slim margins, around about 3%, which doesn't sound like much. This is because retail is competitive and prices are tight. But software companies like Microsoft or Adobe can see margins over 30%. Because once they build the product, selling extra copies, particularly with software, costs almost nothing. Different industries have different normal margins, so always compare a company to its peers, not to a business in a totally different industry. Finally, we have the valuation side, which is the price to earnings ratio. This will help tell you how expensive a company's stock is compared to the money it actually earns. If a company has a price to earnings ratio of 10, investors are paying £10 for every £1 of annual earnings. A price to earnings of 30, that means investors are expecting big growth, or they're overexcited. For example, companies like Coca-Cola or Procter & Gamble tend to trade at higher PE ratios because they're reliable, stable, and loved by dividend investors. Tech firms like Nvidia, on the other hand, often have much higher ratios because investors expect rapid growth in the future. The trick isn't to find the lowest number, but to make sure the price you pay makes sense for the company's growth story. Once we've got a handle on what the company does and how they are performing, we can move on to our risk assessment. These are the types of risks to consider when evaluating a company. First up is concentration risk. This happens when most of a company's revenue comes from one single product or service. Take Meta, for example. About 97% of their revenue still comes from advertising. It's a great business when ads are booming, but if advertisers pull back or users move to a new platform, that income stream can dry up fast. Diversification within a company is often a good sign. That's why giants like Amazon or Apple keep expanding into new areas. Cloud computing, services, wearables, they're spreading their bets. Next, we have competition risk. No matter how great a business is, there's always someone trying to take their crown. Remember how Netflix revolutionized streaming? Now every major studio has its own service. Disney Plus, Prime Video, HBO, the lot. Suddenly, Netflix's once untouchable position doesn't look so secure. When researching a company, ask who are their main competitors, and how easy would it be for someone new to steal their customers? If the answer is pretty easy, the company's moat, its defensive barrier, might not be that wide. And finally, we have disruption risk, probably the scariest one. It's when new technology or trends make an existing business model obsolete. Think about Nokia. In the early 2000s, they owned the mobile phone market. But when smartphones took over, they couldn't keep up, and within a few years they went from world leader to afterthought. On the flip side, companies like Tesla show what happens when you are the disruptor, shaking up entire industries and forcing everyone else to adapt. You can't predict every disruption, but you can look for signs that a company is adapting, innovating, and staying ahead of the curve. That's what separates survivors from the ones that fade away. So, you've done the research, you understand the business, the numbers look solid, and the risks make sense. Now comes the big question. Should you actually buy? This part is less about numbers and more about conviction. Ask yourself, would I still be happy owning this company if the price dropped 20% tomorrow? If the answer is yes, that means you believe in the business long term, not just the current hype. That's the mindset Warren Buffett talks about when he says buy into a company because you want to own it, not because you want the stock to go up. If the answer is no, maybe you're chasing a trend, or you don't fully understand what the company does. And that's okay. Sometimes the best decision is to keep learning before investing. A good rule of thumb, only invest in companies you'd be proud to own even if the stock market closed for 5 years. And that's how I believe you research a company. Step by step, the effortless way. You don't need fancy spreadsheets, insider knowledge, or a PhD in finance to make smart investment decisions. All you need is curiosity, patience, and a clear process, like the one we walked through today. So take it slow, keep it simple, and make your investing effortless.